All right, good afternoon, everybody. Event Trader here, and about to be joined by Brett Manning, Chart Trader, for the latest edition of our Sentiment and Flow show. So, Brett, how are you doing today?
I'm doing very good, Gav. How are you?
Doing pretty good, doing pretty good. I guess we should first break down the markets because I'll be honest, I was eyeing up a possible short in the S&P up around this 3870 level. So let's just go through today's market action as a starting point, and then obviously a little bit volatile today, so we'll continue to keep an eye out on the action moving forward, and then we'll break into the nuts and bolts of the sentiment and flow show. But uh, early take on the action that we've seen here, Brett.
Well, I think that we're seeing a shift from a correction that was more about a rotation out of sort of the super fun Momo stocks, the retail catnip, into an asset class correction, and the failure to see rallies in the kind of safe haven sectors of late is part of that, and I think that obviously it has mostly to do with what we're seeing in the Treasury market. But it just feels to me a little bit different than we've seen over the last week or so, where we've been in this kind of corrective period, but you could still see, four sectors up 1 or 2% on the day, and now it's like the whole market is kind of correcting a bit, and I feel like we're seeing a different stage of it. But it really comes down to whether or not, I think the big question is whether or not we saw let's say the TLT capitulation today. And we'll talk more about that and whether or not it's going to be a self-fulfilling prophecy to get the Fed to do something. But I think if this is going to continue in the bond market, then we're going to see a further correction in equities.
Yeah, I can't imagine, Brett, after because I saw somebody write in asking if we thought that the Fed would just start up a new asset purchase program right now, and I just don't see after a 2-day testimony the Fed really flinching here at all on any of the comments that we saw from Powell. They don't like to they like to be predictable for the markets. They don't like to just surprise people with new programs. I know they did it in March, probably a little bit faster than what people were expecting. Turned out to be the right move, but I can't imagine that they're going to want to change course that quickly after Powell just had 2 days of testimony on Capitol Hill.
Well, so the question is, if you don't do it now, are you just going to have to do it on Monday in a bloodbath in the bond market? Like, is the
Right.
bond market just going to force their hand? They're going to find where the pressure point is. Who's going to? So that's the question, and I don't know if that's necessarily the case or where we're at. I think that's just it's an interesting thought, because in times of the past when we've seen a market start to move, 7, 8, 9 standard deviations, and we're talking about the ability to make assumptions and predictions about the price of future money, and you cannot destabilize that. So I don't know how they're going to handle it. I just think that if they could either be aggressive about this right now, or they might just be forced to do it under worse circumstances.
Okay. No, that I get what you're saying from there. So I mean, their ability to control it too is probably going to remain in question. So we might as well just break right into this since we've already started discussing it, because that's obviously the key item that people are watching right now. What's going on in the bond market, and particularly yields. So we got the 10-year. Here's the chart. You can see that really was just breaking out. Got up to 160 in early trade. Since pulled back a little bit to that 148 area.
Did you see the chart that I posted at 1402?
I did not.
Check out that chart.
All right, let me see if I
I
can
was
pull that.
surprised to see this. This is where I've had this line drawn for a while.
So this is the chart that Brett's discussing here. We've got that up on the screen. So yeah, this is obviously a multi-year, multi-decade chart, and just that
Multi-decade.
bond line that goes back to 89. So I guess it would be about another 8 years of data would have been nice to have for this, right? Because that would have encapsulated the entire
Well, the yields
deflationary
go up to
period.
17%, so
Yeah, yeah.
it's
It
parabolic to the
it
upside further back
right.
in time. Yeah.
It captures the theme for sure, and yeah, that obviously is suggesting now.
Well, we tapped it today, is what I'm saying. I think that's interesting, that trend line.
Yeah,
that's where we flash crashed too, pretty much on the nose.
Yeah, and then just taking a look, I mean, it's not very often that we've broken this trend line here. The one time would have been in late 2018, I guess.
Yes.
And that would have been obviously we're at that point the Fed was in a tightening process, right?
Top of the
Um,
cycle, basically pre-pandemic.
right. We had Trump tax plans would have been starting to be reflected in earnings at that point too, right? So all that would have been
Peak
going on.
cycle fiscal stimulus, and we got to 3.3.
So you could certainly view that as a healthy raise. Now, I don't have the exact months on here, but I'd be curious. Did this top out in 2018, a couple of months right after the trade wars started up?
No, so this was the beginning. You remember that awful Christmas correction we had, the crash, the Christmas
Yeah,
crash, the Santa crash.
right.
This is what preceded it was this top in
The rise
interest
in the
rates,
rates.
and the market stopped, and we saw stocks and bonds moving down together, and it was basically, to me, the way that I thought of it as it's like the shot across the bow, because if you go back, the previous 8 years has been dominated basically by risk parity management of money. So, inverse relationship between stocks and bonds, and stocks and bonds started to move in a way that didn't allow the risk parity model to shore itself up, and we saw raising cash, and that really basically was a stranglehold, and we crashed into the end of the year.
Right.
So this was that period. I don't know if that was
Yeah.
a terrific period for me, particularly in November, December were a couple of the biggest months I've had over the
Yeah.
last few years.
Yeah, no, there's a lot of volatility in the market, similar to what we're seeing here. So I guess, Brett, one of the questions that I would ask you is I've seen a lot of discussions around the bond yields and that the Fed wouldn't necessarily be concerned with a rise in the long end of the curve. A lot of what I'm seeing on the concern around these rates obviously it could crimp the hot housing market, which has been a pillar of the economy for really the last 4 or 5 years, you could probably argue. But they would be in trouble. But for the most part, the Fed's a lot more interested in the short end of the curve, and that's where most of their borrowing is going to be. Now, when the long end of the curve runs up, you see the common theme. The Fed's really nervous about this because they're going to have to borrow at these rates, and that's just going to make it very difficult for us to print out another 1.9 trillion to support a stimulus package or what have you. But the question that I've got for you is, would the Fed be concerned about the rise in the long end if they are borrowing in the short end of the curve, meaning that they're doing a lot more of their moves in 3 month, 1 year type T-bills, and therefore aren't impacted as much by some of the moves that we're seeing at the long end of the curve? Do you have any thoughts on that?
So I would say it's not the level. It's the level of interest rates a little bit, but I don't think that this is that much about the level of interest rates. The Fed cares about the long end of the curve not being unstable and illiquid and crashy. So you can't make predictions about the price of future money if there's too much volatility in interest rates.
Right.
People need to be able to plan for the future. Businesses do. The whole economy and the financial system is in some way dependent upon not having disorderly movement in the price of future money. So the Fed will unquestionably be concerned about it if we see regular 7, 8, 9 standard deviation moves in the 10-year rate. But if it's very gradual and creeping and contained and liquid and moving higher, a little tiny bit each day, I don't think they'd be the least bit concerned. I understand that's going to cause some valuation problems, but, markets will adjust. The Fed's not going to move on that. I think the Fed, that's why today was important, because we saw a flash crash in the U.S. bond market. And maybe it was capitulation again. Maybe things are just going to reassemble themselves, but maybe this market is going to basically put the Fed in a corner and keep pressing until they do something, or at least talk about something. But I think they will be concerned more about the volatility of interest rates right now at the long end of the curve than the level.
Right, and obviously you can see on the chart that we're looking at here, back on February 12th, the market closed with them right at 120, and since then it's a 30 basis point run, and that makes it real difficult, as Brett was saying, to manage money in this scenario, especially if you're looking at longer term CapEx projects, things of that nature.
Exactly.
So now, Powell is saying that this rise was due to an increase in optimism about upcoming growth. There was a Miller Tabak bond note that we had gotten, Brett. I sent it over to you. I don't know if you had a chance to take a look at it, but they were pointing out the rise in term premium, which is basically the increased cost people are willing to pay for longer term debt, on the idea that they would that it's a little bit safer. Are you seeing that in there as the primary reason for the rise, which obviously would not be as positive of a rise as if we were seeing that the rates pop up because of increased expectations for growth in the coming quarters?
Wait, so what was the thesis?
So the thesis from Miller Tabak was that they noted that Fed Chair Powell stated that the rise in rates was due to the optimism about upcoming growth.
Hmm.
Now they did agree with it, and this is in the notes that I had sent you to.
Hmm.
I don't have a good way of getting it on the chart right here, but what their basic argument was, they had the rates juxtaposed against the term premium, which is
Hmm.
basically the difference people are willing to pay for longer term bonds because they feel that it's a little safer. And that has been steadily on the rise. It was at minus zero point 0.5 back on November 2nd, and now it has gone into positive territory of about plus zero point 0.2 in terms of the premium that they're willing to spend. So the idea that people are seeing a little bit more, a little bit more of a bang for their buck and willing to pay up for that, that additional payment that you're going to get from the longer term, and therefore, a little bit more willing to go in and pay up on that rather than just sit around and play in the short end of the bond. Now, do you have any thoughts on that?
So you're saying that it's not caused by growth expectations, it's just caused by managing term
By
premium exposure.
by people preferring to have a longer duration
Okay.
at their disposal because they feel a little bit more safety in it.
I don't know. Honestly, I don't know how to gauge the answer to that question. I really don't. I wish that I had a better answer than that. I don't understand that argument quite well enough to be able to respond to that.
Okay, no, that's fair. That's fair. I figured I'd ask you about it, just to see if you had any thoughts on it. So, all right, I guess, what do you see rates doing? Like, give me three scenarios you see playing out in terms of the rates. I just put up a weekly chart of the 10-year, and we could just kind of go off that for a basis. Obviously, it's been going parabolic, but if you're just looking at it on a chart perspective, now we're getting into the area where we were in around the summer of 2019, and
Hmm.
through the beginning of 2020, where the 10-year was really bouncing around in that 150 to 190 area. That would have, of course, been right up until February 21st, the week of that, and that is when um, we had the first case of coronavirus in the U.S. and selling really started to pick up. I think the WHO had announced it as a global pandemic right around that time frame too. And that's when we really started getting the aggressive rollover. So we're back at that level right now, right around 1.5.
Hmm.
What are some of the scenarios you see here for the 10-year?
Well, so I think that obviously there's a lot of work being done right now to drive inflation, because inflation is a way out of what we have constructed in response to the pandemic to some extent. And I think people really, really, really want to drive inflation. And I think that the Fed is engaged in a process right now, and I talked a little bit about this morning, basically into trying to make a case that people should expect inflation precisely because the Fed doesn't. Right. So I think that if the Fed is prepared to combat inflation, inflation expectations, and the possibility for an inflation quote unquote problem never mature because the Fed is there to take care of it. But if you lose faith in the fact that the Fed is going to be proactive about controlling inflation, that's the way to get inflation. And I made a note about, so I
Now,
don't know if you know.
let me just ask you real quick. When you say the Fed being proactive, are you saying that there's a fear that they would be proactive or that they couldn't control it?
I think that the Fed, honestly, I think that Powell is engaged in a process right now. We've been going for a decade to a decade and a half without an ability to generate inflation. And basically, that's a psychological phenomenon. If people expect inflation and they start to price in the possibility that inflation could happen, that's how you get inflation. Right? I mean, there's supply side inflation. So we've got a number of different factors that are coming together right now. So the Fed is the easiest accommodation that they could possibly be. We've got about $2 trillion about to come into the market. We're just about to have reportedly vaccine-induced herd immunity and this huge unleashing of pent-up demand all at the same time, right? That's a huge mix of factors that are converging to drive something. But there's another factor, which is that the supply of goods, the supply of services. One of the reasons why oil is going up is because over the last 10 months, there's been basically no investment in increasing production capacity for oil because of the pandemic. There's probably that phenomenon woven through all sorts of the copper is certainly another example. That could be something that's woven through supply chains all over the place. And if we have this massive surge in demand with a massive surge in extra money, with the Fed as easy as they could possibly be, I think one of the reasons why the bond market is moving like it's moving is because the bond market believes that we're not really maybe properly assessing the potential for what you might think of as more than the amount of inflation that the Fed would see as ideal, given all of those factors coming together, or at least pricing in the risk of that. And I think that that's what the argument I was trying to make this morning is that's the only way that you get inflation. If the Fed is trying to get inflation, the only way to do that is to allow people to believe that it isn't cognizant of that scenario. Because if it is, if it puts out messaging saying, we stand ready to make sure that we're controlling the level of prices, you don't get that inflation. So it's basically it becomes a self-fulfilling prophecy, and there's a
Basically, with the
huge
idea that
psychological element to it.
basically with the idea that people won't order because they'll be like, well, the Fed will step in here and control this, and
Yeah.
I can
So
get
Hugh
copper.
Henry, I don't know if do you know who Hugh Henry is?
I do not.
He's a really eclectic, somewhat brilliant and interesting former fund manager who's kind of a bit of an oddball. But he did an interview several months ago, and I always find him pretty clever and interesting and insightful. And his point was, if we want to get inflation going again, if we really need to spark this shift, what we should do is name Joe Rogan the new Fed chair.
Yeah.
Basically, take somebody, whoever it is, who's well known but not credible as the chairman of the Fed, and you'll get inflation. And he was really just making a point, right? So if the Fed is able to control inflation, then in a situation where we've got so many kind of longer-term demographic deflationary variables, you're not going to get sustained inflation above 2% because people have too much faith in the Fed's ability to prevent it. So then that expectation never gets built into the system. And I feel like what's happening right now is maybe there's enough concern that we need to have some kind of inflation because of the debt levels that we're starting to build in the system in response to the pandemic, that really the strategy here is to effectively message that they're not the least bit concerned about it, even when pretty much every macro strategist on the planet is pointing to the possibility. So I think that there's a little bit of that game being played. I don't know if that's ultimately the defining point, but I think that what's happening right now in the bond market is you've just got massive amounts of debt, massive amounts of supply, and again, this sort of perfect storm of factors that are all going to converge at the same time over the next several months, and that's being priced in. I think that's pretty simple. And the question is, does it get disorderly in terms of the movements? And I really think, it's possible that right now with a 7 or 8 or 9 standard deviation in the 10-year interest rate for the largest economy in the world, there's a little bit of a point being made right now by the market that the Fed has lost control of that situation at the long end, and it may demand a response. And it depends, I guess, if it intensifies. And I think probably they'll play a little bit of wait and see.
But doesn't that destroy the whole theory that Powell wants people to think that he doesn't have control, so therefore
that wouldn't be about inflation. That would be about disorderly movement in a market.
Okay. All right. I mean, the moves over the last 2 weeks could kind of suggest that, no?
I, I mean, well, the move today certainly suggests a disorderly. I mean,
Yeah.
this is not an orderly move
I,
higher. That's for
I,
sure.
I just I just think it would be real tough, and I guess that they would have no other choice but to do it for them to say that they're setting their policy that they're not even thinking about raising rates and stuff, and then as soon as something happens, that they have to go running and flinch.
Yep, right. I
So
get you.
so
It's
so,
not a good
so
look. It
yeah.
doesn't look good. Yeah.
Yeah, I think if anything, it would spiral further out of control at that point. I
No,
think,
well, I mean, they can brute force it. I mean, at that point, like if that's what we're talking, I think if there was any notion that the Fed was going to get involved, twist up the curve, that this would stop for now.
yeah,
And maybe later it would happen again. But I think that the market is just basically saying there's no safety net here. And we're about to have vaccine-induced herd immunity and a reopening and $2 trillion more and no supply chains. And so, what's going to happen here?
yeah, yeah. All right. So, well, let's move on. I mean, this is going to be a running theme throughout everything that we're discussing here. We'll get into the inflation expectations from the Bank of America Fund Managers Survey and a number of other items too. But first, let's take a look. Brett, you had sent me off the latest Ray Dalio piece, and the basic premise of this was, are we in a bubble? And there's a few interesting takes that I thought, and certainly this is with regards to equities, of course. So we're changing gears a little bit. And some of the numbers definitely suggested that we are at the high end of what many would consider a bubble, but there's still some upside potential there. And just to run off some of the numbers, the current read of the price gauge of U.S. equities is around the 82nd percentile, which, according to Dalio and Bridgewater, that was shy of the bubble seen in 1929 and 2000, when this figure got up to just shy of 100%, right? So, but there was one other aspect to it too. They kind of broke it down into a subcategory, so I'll throw both of them
But
at
before
you.
you do that, I want to make one point.
Yeah.
This is what I said to myself the moment I looked at it. If you look at the 1990s, it gets up to 100% halfway through the decade.
Um, yeah.
And
Yeah.
then the market triples.
And then the market
So
triples, right?
I'm saying it's not a sell signal, even if it is a bubble. This
Right.
is this is the interesting point.
Yeah. Yeah, and again, like you said, not a sell signal, but one of the other aspects, the subcategory that I found interesting was currently, um, they had an indicator running around the 77th percentile for the aggregate market, which was a secondary entrance into it that, again, is full under the bubble. And this, I guess, would be more of the retail crowd and people late to the market there, where they had that as a secondary chart. And that was even lower at 77%. This also reached 100, hit close to 100% in in 2000 and 1929. So with that in mind, what's your basic takeaway from the charts that you're looking at here in terms of the amount of involvement in the markets?
So I think that there's pockets of bubble and there's pockets of not. I mean, that's one of the reasons why I've been kind of looking to short NQs and buy YMs. I mean, you're seeing like kind of a flip in the Dow Nasdaq ratio. You're seeing new leadership. Energies could have a mile to run. Financials are breaking out, and at the same time, you have pockets of the market that are clearly super bubblicious, and we've seen just massive frothy retail involvement. And I think of it's like a cake, and and we'll get into the larger sentiment data discussion, guys. So we're moving toward that now, and maybe this is a kind of bridge to that. But there's a cake, and it's baked of very low cash levels for major portfolio managers. You're seeing asset allocation models that are at, like, the Bank of America one is at like 64% or something, which is the highest all time in terms of their sort of broad wealth management. And then at the same time, you've got this boom in calls from small accounts, this robo ratio boom. So you've got these small retail market participants levered up on derivatives, and you've got this, that's the icing on the cake. And then you've got the cake itself, which is really low cash levels in institutional managers and really high asset allocation but it's very sector specific, and it's very kind of in spots. And I think that you don't have anywhere near that kind of participation in something like the energy sector, or in the banks, or in the industrials, or the sort of heavy cyclical side of the market. And we'll talk about the reflation trade in a bit, but that's it's sort of evening that up a bit, but it's been overwhelmingly speculative in certain pockets of the market. And I think that
and by certain
Dalio's report kind of
like
highlights
you're
that as well.
saying too. Yeah, and by certain individuals, as you're saying, where the retail is definitely seems to be the more levered up of the two, and that's why you're seeing a lot more of these gyrations in that tech
Yeah,
space.
and it's a short fuse too. Like it takes a small fall before you start to get to this sort of what I call beta delta gamma. With the options boom, you just get to this point where you've got a small move that triggers a kind of early margin call among small traders, and we get these pockets.
Right. And, just going back to the markets here, we're seeing us dip down about 20 points from those levels that I was talking about just prior, right around 38.70. So we are getting a move back down. We've broken that trend line from around the lunch period down right now. And I guess that's one of the things that I'd ask you about in today's action too, Brett, where we're talking about retail being in a certain area, and that area getting hit, and that would be the tech level. But now we're starting to see a little bit more broader selling. Do you think some of the pain that's being seen in the tech area is forcing maybe a few shops to sell in other areas in the cyclical side?
Well, so that's what I said right when we started. I think today is a fence top day, and we're possibly going from seeing a rotation consolidation to an asset class phenomenon correction. It's possible. It kind of feels a bit like that to me, that there's a different level of offer. And again, we go back to the cash levels, right? We've looked at that before. For the last several sentiment and flow shows, we've talked about this. When you look at the Bank of America flow show, or the fund manager survey, or whatever else, showing cash levels go from 4.8% to 4.5% to 4.3% to 4.1%. Now I think it's like 3.8%. And that's really, really low. That's really tight. That means everything is really basically out there. And, we are going to get leverage shaved off because of the increase in volatility in the price of money. So interest rate volatility leads to reduction in leverage. But then at the same time, large portfolio managers aren't carrying cash. So if we start to go from let's chop down the ARK bets and, the Bitcoin stocks and Tesla, if we start to go from that version of a correction to everything, SPY index exposure, et cetera, because there's cash raising. So that's possible that this is shifting from a rotation where money's going out of hot speculative, mid-cap tech stocks into ExxonMobil, versus are we just going to reduce leverage and raise cash a little bit because we're seeing some stuff that's, everybody's juiced up on this rally. We've had a huge run. There's tremendous expectations, but it's a bit of a crowded bus, and we're starting to see some funky stuff go on in the bond market. And so maybe it's time to shave the leverage off and bump that cash up from 3.8% to 4.2% over a 2 or 3 week period and take stock of things. And if that's the case, then we have an asset class correction, which is, the market rolling over. I mean, we got the failed breakout in the Dow pretty much in the books here. We blew up yesterday to 32,000, and we've given it all back. And the other two, S&P and NASDAQ, that I'm really watching closely are, they never made the new high, and they're well off it now. And we're eating the tail. And we've talked about that term, eating the tail.
Right.
And we're eating the tail. So what that means is you got this big tail a couple days ago. You look at the S&P tail, it almost touched the 50-day moving average, left a huge kind of doji tail phenomenon. When you start to eat into that tail, there's going to be a lot of money that came in after the establishment of a bar like that, because it's kind of an alarming bullish candlestick in a situation where you've got an uptrend. What it basically means is people got shaken out into the brutal kind of selling of Tuesday morning, and then the market rebounded back enough, and those same people chased right back in. if we start to erode down through that tail again, you get to the point where you start to get these cascades of stops where people basically set that risk, midway to past midway down that tail. When you eat down through that tail, you can start to get just kind of a chain reaction selling. So it's really not healthy in a pattern like this. You can get a larger correction just off eating a tail like that. And with the Dow breakout failing, we're going to need some big support to come in. We're going to need some new strong hands to come in. And either that or the Fed just comes out of the blue here. Williams is talking later today, I believe.
Yeah.
If his speech has been rewritten and suddenly he starts to have a different tone about what's going on in the bond market and that the Fed is watching it closely. I think that's just about all he'd have to say, right? We're watching it closely. As far as
just a threat of a twist operation, basically.
Well, I think that's it, isn't it? I mean, I don't think they need to go in and pile in, full QE up the curve. I think that they just need to say, we take this seriously. We're not going to allow disorderly movement in the bond market.
Yeah.
I think that would do it.
It'll be interesting to see, especially just coming off the Humphrey Hawkins testimony. The Fed would loathe to do that, especially given how steadfast they've tried to bend. So something for us to keep an eye on. Williams, like you said, later on. So I think Brainerd might be out later too, and that could be pretty important since there's a potential, at least it's been rumored, that Biden would like to put her in Powell's chair position. So, it'd be interesting to see too if she just kind of
she's got an extra spotlight.
Yeah, well, she's got an extra spotlight, but also if she wanted that chair seat. Didn't mind poking the bear, but that's conspiracy theories, of course.
Yeah, right.
So
I can't believe how he's mishandled this.
Yeah, exactly. I don't think she would come out that way, but I don't know. It'd be certainly something of interest. So
that'd be great. Fed office politics.
right while the bond market's going bonkers. That's exactly what we need. So last thing on the Dalio piece that I just wanted to touch upon, Brett, you could comment if you like, but I found it interesting that their indicators for CapEx, which is, of course, business spend, less any government spending at all or anything like that, it's running pretty light, which reflects that that pent up demand that you're hearing a lot about. They still haven't really put it into action, given the CapEx aggregate that Dalio and crew were looking at. And we'll get into this in a second, too, on the fund managers survey. But this kind of points to why I think that anything we're going to see here, Brett's going to be a little bit more of a correction, because there's a lot of liquidity out there, and there is a lot of pent-up demand. It's certainly impacting things right now. You've seen the semiconductor shortage, which we talked a lot about on the trader strategy meeting. You're seeing the rise in copper just going ballistic here. Silver as well, seeing some strength there, and I don't think that that's just all the Reddit crowd at all, but this is all due to people competing for materials out there. And I found oil as well. And nat gas. I mean, I found it interesting, though, with how low the CapEx number was on this Dalio chart here, which, again, points to bigger inflation potentially in the second half of the year, because it's going to be interesting the next few months, right, Brett? Where we're going to have real easy year-over-year comps in CPI and PPI.
Right.
And, we're going to get PCE prices tomorrow, so that's definitely going to be the big number of the day for tomorrow. But, so they're going to have to talk the market down that, this is just temporary. But if we see this CapEx just continue to float into the second half of the year, that's going to be a lot tougher story to sell to the public, don't you think?
I guess, but yeah, but you make a good point. So it's really difficult to want to be not involved in the stock market once it works out its hurdles for the next. I look at like mid-July as this crystallizing moment, right? Because you've got this massive next wave of stimulus. You've got right about the early summer would be the kind of late part of the optimistic range of the sort of pent-up demand unleashed and people going to the grocery store without wearing face masks, and the sort of the exuberance of reopening. You've got Q2 earnings reports coming out where year-over-year comps with a negative 30% GDP quarter. You've got all these things kind of that are combining in that moment. It's really difficult for me to see that not being something that, you're going to see a lot of people want to be. And then let's not. So the new stimulus checks are coming. And I saw a Deutsche Bank survey that suggests that, according to their research, the average American receiving their next big check from the government has already kind of got an average level of 37% they want to put into the stock market, which is over $170 billion just flowing into equities from retail investors. So all of that together, again, right. So if we see some asset class version of a correction here, I mean, at some point there's going to be the buy point on it, and it's going to be probably an important one.
Right. And the other thing we could throw out there, just if you want to get your blood running, Brett, is we got a G20 meeting this weekend too, right?
Oh my!
So the
I
bond
don't think they
market.
matter anymore, do they?
They
Trump's out.
don't, they don't matter, but obviously Yellen, it's going to be like her first time there, right? And well, I guess they're doing it virtually, but I'm just saying in terms of overall bond market shaking out, and we're breaking
Right.
down here a little bit further in the S&P, but yeah, that G20 meeting could also carry a little bit of added importance going on. And
Mhm.
we're about to come crashing down into this 3830 area. Should have just put on the short, like I said I was thinking of when we started this, right, Brett? But
Yeah.
so okay, let's move over to the Bank of America flow show here. I wanted to spend a lot of time on yields and inflation because I really feel like that's a little bit more important. I don't think we've seen a great divergence since the last time we talked, Brett, 2 weeks ago on the flow show, and I think that a lot of the data that we're seeing, isn't going to come as a surprise. For to wit, 30-year Treasury prices, they've been down 9.4% year to date. This marks their worst start since 2013, which is the taper tantrum, right, Brett?
Sure.
So, I don't think that is all that surprising. I guess I did see expectations for rate increases are on the rise now for 2023 and 2024. That's the first time I've noticed that.
Hmm.
Have you been paying attention to the CME data? Do you have any thoughts?
I have. I like it's bouncing around. Every once in a while, you see a little uptick. We saw even the September of this year get to like 15% several days ago. So there's a little bit of that, and I guess the question is, are we going to see the Fed put under pressure by having to chase the market rate? And that's that's a
That,
whole separate drama.
that's a whole different ball of wax, right?
Hmm.
So, and again, the collection of this data is February 11th to the 18th. So, it's not going to encapsulate this week's action. So I would just include that in. But that week we did see a big flow of 27.8 billion in equities, 12.6 billion into bonds, 2.1 billion went into cash, and only 31 million went into gold. So I think that the flows for are pretty much online with what we've been seeing. But I guess we'll just ask you about gold real quick, Brett, and I'll just go off the
Well, but
G.
first, let's point out that that's 44 billion out of cash. Oh no, 2 billion into cash.
2 billion into
So,
cash, yes.
right,
Yeah,
right.
so,
My bad.
so yeah, so it really went across the sector there. So I guess with that small amount going into gold, obviously a lot of focus on Bitcoin as of late. But do you have any thoughts on GLD as we're coming into this key support level? I'm still long it from 153. Obviously giving up a bunch of the gains. I still view it, given all that we've just talked about, as an inflation hedge, but it certainly seems that it has gotten overtaken by Bitcoin, at least in demand near term here. Now, you had an interesting take in terms of what you're seeing in Bitcoin and the argument about its storage and value. Do you want to share that?
Well, so first of all, gold is suffering from the fact that we're moving toward threatening to move out of negative real interest rates, and that's really an assumption about where inflation is. And where inflation is right now, according to the data, it's difficult to say. It's difficult to say what we're about to see in inflationary data. And if we start to see uh, inflationary uptick. Now, maybe the inflation's already there. So the question is, we've been baking something in, and we're about to get all this extra money, and we maybe have supply chain constrictions, and we're seeing this parabolic move higher in oil. We're seeing a parabolic move higher in copper. Who knows what else may be set for the same kind of situation. And so, the data right now in real time is that we're moving out of the possibility of negative real interest rates, and that's probably the most correlated indicator for gold. And right now, I think the gold market is pricing in the possibility that we move out of negative real interest rates, but that may be really flawed as we start to get more data on where price changes are in terms of the broad economy. So it's really kind of a race about data and what people's assumptions are about real interest rates. But as far as Bitcoin is concerned, yeah, so I think that what we're seeing right now, and my position on this has been, what we're seeing right now is a network effect. So when I use the example of when, if you go back, maybe it was 2006, 2007, I can't remember when Facebook really kind of suddenly dominated MySpace, but they were neck and neck for a couple of years. And then it was all Facebook, and MySpace basically was, cast off into the scrap heap. And really that's because you are on either Facebook or MySpace because it's a social network. And if people, generally speaking, gravitate to one of them more than the other, then that becomes a self-reinforcing feedback loop, and instantly it's gone. There's no competition anymore. It's like, so if I want to get really abstract with analogies here, which I love to do, if you go back 4.5 to 5 billion years ago, and you look at the solar system, there's a gigantic star in the middle, and then there's a disk of dust around it, right? And 9 different clumps of dust got slightly bigger than the other clumps of dust. And the effects of physics and gravity meant that those are the planets, right? So as soon as you get a little bit of a lead, everything piles into that. It becomes a self-reinforcing feedback loop. And we've seen from Bitcoin the idea of a digital form of currency that has gotten clearly ahead of any other version of something like that with increasing legitimacy. If we go back several years ago, the banks were all against it, saying it was just for terrorists and drug dealers, and no major corporation would have anything to do with it. Now, J.P. Morgan likes it and is bullish on it. So is Goldman Sachs. Tesla now, you can buy Teslas with it. Squarespace, PayPal, you can use it in PayPal. I mean, it's becoming legitimate and it's gaining traction. And the network effect force suggests that the long-term picture, if there's not some major problem in terms of cybersecurity for using it, as we start to get better at processing it, it's inefficient right now for transactions, but if you look at 10, 20, 30 years down the road, that may not be the case. I think that's really the driver, is that it can function as the world's leading digital currency possibly, and it's getting network effect traction in that direction, and that means that it can be used as a store of value now simply because it's not going to simply disappear. It's not going to go back to 10,000 a coin unless there is some kind of major crack in the veneer of security in terms of cybersecurity. So I think that the network effect point is the important thing. As it picks up more support, as it picks up more utility, as it picks up more buy-in, that becomes a self-reinforcing feedback loop, and that will just continue. And I don't know where the value of it should be. I don't know how to value that, but I just know that it was valued at 10,000 when it had no legitimacy and no network effect traction. So clearly, as it picks up more and more network effect traction, the value of it is higher.
All right. And again, we're keeping an eye out on the markets here. We're back to testing this 3830 level. I think that it's going to have a real tough time holding up above this level, Brett. I'm looking for a test of the 50-day moving average myself here, so which is right at 37.99. So we'll continue to monitor markets here as we go along. So, Brett, just kind of continuing on with some of the data that we were seeing, I thought it was interesting that they were taking a look back around 1994 when, in terms of looking for some similarities, where we got us we just recently got a big January retail sales number and some pretty strong data, and they were kind of reflecting it back to February '94 when there was a huge jobs number that came out, which ended the early '90s jobless recovery. This one would be an end of the reopening trade, and that would eventually incite some Fed rate hikes, and that we would jump in with the bond bear market would end with the Orange County and Mexico bus in late 1994.
Hmm.
So I guess I'm just curious if you see this kind of repeating itself here with the action that we're seeing.
You mean the what? What repeating
All of a
itself?
sudden, we're going to get strong economic data that's going to force the Fed's hand. Like if we see a high PCE number and
Right.
this economic data continues, do you see the similarities to '94?
I don't know if I see the similarities to 1994, but I see that I think that the Fed is intentionally trying to position itself as being publicly perceived as being behind the curve, because I think that there's been a discussion that using the communications pathway, their goal is to stoke inflation. The way to stoke inflation is to present themselves that way. I explained this earlier. That's what I think that they're doing, which necessarily means yes is the answer to your question eventually.
Okay. And then the other interesting aspect I thought from the Bank of America show, the Bank of America flow show, was they had a gentle rise in inflation from 65 to 68, where small cap value, tech and growth, and pharma were some of the big winners. But then we saw a sharp rise in inflation that led to commodities really seeing a big win there. Copper was another big winner. Do you see any asset classes that you're paying a little bit more attention to, given some of the moves that we've seen on the inflation front and in the stock market?
Well, I mean, so I've been really bullish on energies and I've been really bullish on oil, commodities in general. But I think that it goes back to the idea that when we talked about this a lot. So let's go to the reflation argument here a little bit because
Yeah.
we want to get this in. And we talked about this a lot in August,
Oh,
September, October,
yeah.
right? Where we were basically making the case that there's a lot of data that we saw that suggests that nobody believes that inflation can happen, right? Like that's where we were. We were at the ultimate moment of inflation is impossible forever. It was that ultimate moment, and oil was this hated thing that was maybe back at $30 a barrel, but it had been to negative $40 a barrel, and it's impossible to see the future where suddenly you've got oil at 60, 65, and people are looking for $100 oil, and everybody in the world expects inflation. And that's a sentiment and flow show kind of concept, right?
Right.
If everybody's all agreeing with one thing, then that's the last thing that can happen. And in other words, it shows the vulnerability, because if you start, nobody's positioned for this. I think that was the way that we put it over and over again. Nobody's positioned for this type of shift. And therefore, this type of shift becomes more likely because the repositioning, just on the first hint of it, has to happen. And then the other idea related to all of that is when you go through a period where people aren't expecting there to be increasing demand for, let's say, commodities, when you're in that situation, that's more than just a financial market concept. That's an oil company concept. That's a private equity concept, that nobody is putting money into developing new resources to produce more copper, for instance, right? So you fall behind the curve, and then suddenly you find yourself several months later where, oh, wait, it looks like we're going to need a lot more of that stuff, and there's not the infrastructure to do that very quickly, and it takes time. And so we're seeing a lot of this really had to do with we're just not prepared for the level of demand that's coming in at this point. The supply and demand is imbalanced, and that would be before $2 trillion more of stimulus, and before an unleashing of pent-up demand from vaccine-induced herd immunity and reopening. So, I mean, and this all effectively ends up being the same conversation that we had about rates, because it's all, the same side of the same coin.
Yeah. Okay, so we will now move on to the fund manager survey, Brett, as we're running about at 3:20 here. So the first line of the fund manager survey I found was to be pretty interesting, and that is the only reason to be bearish is that there is no reason to be bearish. So you got any thoughts on that?
Yeah, it's a sentiment idea, right? I mean,
Yeah.
it's the same thing. So it's the basis for us doing this show is that positioning is destiny. And when everybody's on the same side of something, it's very difficult for that thing to not be vulnerable in the opposite direction. I mean, there's a positioning rebalancing that's part of what happens in markets. And I think that's the same thing that Hartnett is pointing out there. Is they're getting to their point with the indicator that comes from the fund manager survey. Is getting to the same point that we've been making, where you start to get to the icing and the cake are all lined up in the same direction, and that itself introduces vulnerability, regardless of the fact that, again, into this crystallizing moment in maybe July, mid-July, when we're getting, Apple coming out with its biggest year-over-year growth number in history because of what it was facing, or whoever, like everybody, basically, when they're comparing to Q2 of 2020, right after $2 trillion of stimulus. There's still this tremendous thing to trade into, but the market needs to rebalance itself at times, and interest rates are forcing that right now. And I think that line is a perfect way to sum that up.
All right. And then some of the other items, it's all going to really kind of support what Brett was just talking about here, right? 91% of investors say a stronger economy is expected in 2021. It's certainly being reflected in the rates. The majority now saying it's a V-shaped recovery. I think that's a little bit late to the little 20 hindsight being 2020 there, right, Brett? Now, here's one thing, and I kind of wanted to build off the Dalio thing in terms of CapEx. This was, and we talked about this a couple of months ago on the show, where this is the first time since January of 2020 investors want companies to increase their CapEx rather than improve their balance sheet. And again, that harkens to the idea that people are underinvested in terms of building their inventories and stuff. And that just all leads to my expectations, Brett, of inflation being an ongoing issue and not really just a temporary blip that we're going to see it against those easy comp months, and really a rush for filling up inventories and handling the supply chains. And I think that's going to be the differentiator between companies in 2021. Who's able to do that more effectively?
Absolutely. Yeah, right.
You got any additional thoughts on that CapEx number that we saw?
No, but I agree with that 100%.
All right. Then again, Brett mentioned the cash levels before. They are at 3.8%, which is the lowest since March 2013. Again, just before the taper tantrum.
Yeah.
So, a lot of parallel.
So if that goes to 4.2%, I mean, that has an enormous impact on
Let me ask you this though, Brett. Is that 3.8% you think of 3.8% of a bigger pie, given the amount of liquidity that's pushed in there?
Well, I mean, it's assets under management, right? Whatever. Now, I suppose if you're getting a lot of people who are, getting their stimulus check and sending it to a fund, then their assets under management are growing.
Yeah.
But whatever, it's a survey of large fund managers, and they've got such and such X amount of assets under management, and 3.8% on average is in cash, and everything else is in play.
Right. We also saw allocation of stocks and commodities the highest since February of 2011. So, I mean, I still see some further upside to this commodity cycle here, but do you think that allocation is simply higher just because we're coming off of such a low base?
Well, I think that people see the same thing that we've been talking about. You can't very quickly massively increase production capacity of a commodity. And if you go 8 months without any investment in increased production capacity, which we did last year in a lot of different commodities, then things start to grow faster. Right now we're seeing stronger than expected economic data, and we're going to see more fiscal stimulus than maybe had been predicted in, as of, say, October or November, when people are making decisions about how much to invest in new commodity production infrastructure. So those decisions take time. And if people weren't investing in producing more commodities in October or November, then they can't just realize now that, look at what happened in Georgia on January 5th, right? Like, I think that allowing for budget reconciliation to get through a stimulus bill this large was really unexpected. But right after that, I mean, that's where the big breakout in interest rates happened, and that's where the big breakout in a lot of things related to this happened. And I think that you can't just the next day suddenly start mining more copper or
Right.
pumping more oil. It takes an inflow of capital. It takes a project. It takes all sorts of things to increase total production capacity in the system for any given commodity. And I think that it was a little bit of a gimme trade maybe, and I think that there's a lot of exposure to it.
Right. And for anybody looking for a real-time example of Brett's eating the tail, I got the 60-minute
Yeah,
chart of the S&P minis here, and this is
starting to cascade through.
yeah, this is textbook breaking through that 3830 area. I still see a test of 50 going into the close here.
And I would point out Williams is out. He didn't say anything about it, and the 10 years back on the lows and the futures highs in the rates.
All right, there we go. Let's see, Brett. Then record number of investors taking higher than normal risk. I don't. That's
There you
we're
go.
talking about that, and it also
Icing a cake.
yeah, it leads to quicker flush outs. This one's always a good one. Viewing of the tail risks. Now, the vaccine rollout was number one, Brett, but I think that's a little misleading. It came in at 28%, and the timing of a positive impact from the vaccine rollout is slipped back to July. It was June prior. However, number two was a taper tantrum at 25%, and number three was inflation at 24%. I would argue that you could combine those two, and technically that's 49% of the risk fears there. Would you agree or disagree with that?
Absolutely.
Yeah, so it's funny because it kind of always, when we see down at 2%, people are worried about credit bubbles bursting, and it's always just like a domino effect. So the big fear here is the taper tantrum and inflation right now, and we've seen that play out. No surprise. So let's see. Then 86% of investors expect higher inflation in the next 12 months. Now this was actually down 6% month over month. Were you a little surprised at that?
I don't know really how to. I suppose that there's 6% that are thinking that Powell is right. I guess. I mean, the central bank has done a lot to temper expectations of inflation.
Okay. Only 13% of investors think the U.S. equity market is in a bubble. Are you surprised at that number, or does that probably fall in line with what you think?
I guess given the economic assumptions, that would be pretty straightforward, right?
Yeah.
I mean, there's, the highest number ever is thinking the economy is going to strengthen a lot. So bubble is really a concept that has to do with the market prices moving higher without economic justification.
Right. And then we got investor optimism on stocks increased to a net 61%. It's the second highest ever. Number one, February of 2011. So as you can see, a lot of parallels to 2011 and 2013 in these numbers.
Yeah, right.
And then finally, just to kind of circle back to gold, 8% of fund managers think gold is undervalued. This is the first time since June of 2020, and that was right before gold would rally 22% in the following 2 months. That's why I think it's real interesting at this 165 level for gold to see if we see some money moving back into it.
Well, and again, if all we need is some data point to suggest higher inflation right now. What you think real interest rates are is really a function of what you think inflation is at. And if we're just not seeing the price change recorded yet in the data, but it's going to be, and that might be something you take from really rapidly rising commodity prices passing through the system, or the stimulus checks going out, or what have you. But then you start to see that I think that there's just a lot of almost algorithmic relationship between the level of real interest rates and the price of gold. And the level of real interest rates is a function of what you think current inflation is.
All right. So that's basically going to do it for us here. We're right near the session lows, that's slipping to 38.24. And, my key takeaways from our discussion here, Brett, is obviously we're keeping a close eye on rates. It's going to be interesting to see if the recent price action starts to escalate and forces the Fed to move their hands. I'm of the mindset that they're okay with the long end moving, and that they will try to avoid disrupting their current message. But as Brett was saying, that might change, and that could cause them to move a little bit quicker and cause some further gyrations in the market. Now, all of this big change in bonds is cascading its way across the stock markets into a reallocation of sources here. And, during periods of this, we'll usually see a choppy downside action until people can get a little bit more comfortable with the environment that they're operating in. And that could take a couple of months because there is still some uncertainty about the vaccine, the reopening recovery, how is the rising bond rates and how that impacts borrowing costs. So for me, it's looking, at least in the immediate term, like a little shorter, choppier downside action that I'm expecting to see. Hopefully we'll be back here in about 2 weeks and we'll be able to take another look at this. But Brett, what are your key takeaways from today's discussion?
I suppose the big point is that there's this cake and icing issue. So if there is a problem, then people are exposed to it and vulnerable, which means you're going to have an asset class correction. And it's feeling a little bit like we're shifting mode right now into that kind of mode. I think that could be stopped by the Fed finding a way to signal that it's not going to allow disorderly movement in the bond market. They wouldn't really necessarily have to say that, they're changing their view of reality, just that there's a market behaving badly and that they're not going to allow it to continue to do that. I think that would at least be a temporary boost to things in the equity side. But overall, right now, I think the fact that everybody had such low cash, there was a lot of leverage, there was allocations at all-time highs, expectations of positive things, the great expectations idea. I think that suggests that there's enough vulnerability that this could be a little bit more important of a downside move, and I think we're going to be reading tape, and I like to let the first day of a shift in mode kind of play out without doing necessarily that much, and then start to understand the patterns that happen in reaction to it, which would be maybe make for an interesting trading day tomorrow and the following Monday.
Yeah, yeah. At end of the month too, of course, right? Last day of trade for February. And again, we got the G20 out over the weekend too, so curious to see if anything comes from there. But Brett, for everybody out there, we did tape this. We will be posting it shortly. Brett, always fun to talk to you about this and kind of walk through what we're seeing in the markets, and hopefully everybody found this pretty useful. So, Brett, we will talk to you shortly, and you take care. And everybody out there, I'll be back on in a couple minutes to take a look at the upcoming earnings after the close, as well as continue to comment on the market price action that we're seeing here.
Yeah, okay. Thanks, Gav.
All right, talk to you soon.